What if I told you that while everyone's been distracted by headlines about trade wars and political drama, China has been quietly executing a strategy that could completely reshape the global economic order? And here's the kicker. Most people, including many so-called experts, have absolutely no idea this is even happening. We're not talking about tanks rolling across borders or diplomatic negotiations making news. We're talking about something far more subtle, far more patient, and ultimately far more powerful. China is systematically cornering the market on the physical resources that power modern civilization. And the implications for your savings, for your investments, for the dollar in your wallet, and for the entire next decade are absolutely staggering. Before I dive into this, I need you to understand something. What I'm about to share isn't conspiracy theory. This isn't speculation or fear-mongering. This is documented strategy backed by billions of dollars in actual transactions happening right now across global commodity markets. And once you see the pattern, you can't unsee it. So stick with me here, because by the end of this video, you're going to understand the real game being played while everyone else is watching the distraction. Here's what's actually happening on the ground. China isn't just the world's factory anymore. That's old news from 20 years ago. They've evolved far beyond cheap manufacturing. What they've become is something much more strategic and infinitely more dangerous to Western economic dominance. They're positioning themselves to control the supply chains for nearly every critical material that modern technology depends on. And I'm not exaggerating when I say every. Semiconductors that power your phone and laptop, solar panels that everyone says are the future of energy, electric vehicles that governments are mandating, defense systems that protect nations, aerospace technology, advanced manufacturing, medical devices. All of these industries require specific metals and rare materials to function. And China is systematically locking down global supply at a pace that should be setting off alarm bells in every Western capital. Think about the implications for just a moment. If you control the raw materials, you control who can manufacture. If you control manufacturing, you control prices. If you control prices, you control economies. It's not complicated. It's actually beautifully simple when you step back and look at it. And Beijing has been playing this long game for years. While Western nations were focused on quarterly earnings reports and election cycles, we're talking about a truly comprehensive national strategy to secure industrial metals across the entire spectrum. Rubidium, which is essential for catalytic converters and chemical processing. Palladium for electronics and hydrogen fuel cells. Platinum for everything, from medical equipment to petroleum refining. Rare earth elements that sound exotic but are absolutely critical for magnets in wind turbines and electric motors. Copper, which is the backbone of electrical infrastructure. Lithium for every battery technology. Cobalt for battery stability and jet engines. Nickel for stainless steel and battery cathodes. And dozens of other materials that most people have never heard of, but that civilization cannot function without. This isn't opportunistic buying when prices are low. This is systematic strategic stockpiling by state-owned enterprises backed by government policy and unlimited funding. The scale is genuinely difficult to comprehend until you start adding up the numbers. We're talking about billions of dollars being deployed month after month, year after year with singular focus. The evidence is everywhere once you know what to look for. Unusual price movements in obscure metal markets. Chinese companies outbidding Western firms for mining rights in Africa and South America. Massive increase in Chinese metal imports even when their manufacturing output is flat. Strategic reserves being built that dwarf anything Western nations maintain. Let me put this in perspective. China already controls somewhere between 70 to 90% of global rare earth processing, not mining processing. Even if rare earths are mined in Australia or the United States, they often get shipped to China for processing, because that's where the expertise and infrastructure exists. These elements with names like neodymium and dysprosium and terbium are absolutely critical for everything from smartphone screens to missile guidance systems to MRI machines. Without them, modern technology simply stops working and one country has near monopoly control over the supply chain. Now they're expanding that same dominance to other metal categories systematically. If you control the materials, you don't just control manufacturing. You control innovation itself. You control which countries can build advanced industries and which ones are dependent on you for permission. This is economic leverage that doesn't require firing a single shot or signing a single treaty. It's power that comes from patient, strategic positioning. And here's the absolute genius of this approach that most people are missing. Every single dollar that China spends buying physical resources is a dollar they're converting out of US currency and into real assets with intrinsic industrial value. Think about what that means. They're dumping paper for tangible materials that have actual utility in the real economy. China accumulated massive dollar reserves over decades of running trade surpluses with the West. Now they're methodically converting those reserves into the literal building blocks of future technology and industry. It's one of the largest and most consequential wealth transfers in human history. And it's happening in plain sight while everyone's distracted by other things. Let me ask you a question. If you had $1 trillion in a currency that's being printed into weakness, what would you do? Would you keep holding paper, or would you convert that paper into physical assets that maintain value and provide strategic leverage? China chose option 2, and they're executing that choice with ruthless efficiency. The tariff policies that have been implemented over the past year have actually accelerated this trend in ways that probably weren't intended. By dramatically reducing trade volumes between the US and China, fewer dollars are flowing into China's economy through normal commerce. So, what's Beijing's response? Are they panicking and begging for a trade deal? Not even close. They're adapting in exactly the way you'd expect from long-term strategic thinkers. They're trading less in dollars and increasingly in renminbi with their global partners. They're using their existing massive dollar reserves to aggressively buy resources before those dollars lose more value. And they're building alternative trade and financial systems that don't depend on Western infrastructure or rules. If you think this is just about economics, you're missing the bigger picture. This is about the fundamental structure of global power, and it has massive implications for dollar strength going forward. The US dollar is already on track for its worst year since 2017, declining more than 8% against a basket of major currencies. Now, when I say the dollar is weakening, I'm not talking about normal day-to-day fluctuations that happen in currency markets. This is a structural shift being driven by fundamental changes in how global trade works and how countries choose to hold their reserves. Options traders on Wall Street, the people who literally make their living betting on currency movements, are extremely bearish on the dollar right now. And they're bearish for a very specific reason that you need to understand. Dollar down cycles that are driven by structural factors rather than temporary sentiment typically last 5 years or more once they begin. We've seen this pattern play out historically multiple times. This isn't a dip that recovers in 6 months. This is a multi-year trend driven by forces that don't reverse quickly. And we're only in year 1 of what could be a very long journey downward. If you're finding this valuable so far and you want to stay ahead of these trends, do me a favor and hit that subscribe button right now. I spend serious time researching these deep structural shifts that mainstream media either misses completely or dumbs down into useless sound bites. Your subscription genuinely helps me keep producing this kind of in-depth analysis, so click that button. Now, let me show you a perfect real-world example of exactly what I've been talking about. Look at what's happening in the silver market right now because it illustrates this entire broader story in vivid detail. Silver prices have gone absolutely parabolic over the past year. We're talking about trading well above $76 per ounce currently. If you had the foresight to buy silver at the beginning of 2025, you would be sitting on gains of approximately 150%. That's not normal market behavior. That's not gradual appreciation. That's a supply shock meaning absolutely unprecedented demand. Now, here's what most people don't understand. Silver used to be categorized primarily as a monetary metal, something used for coins and as a store of value, plus some industrial applications. But it has fundamentally evolved into something that's now classified by governments as strategically critical. Why? Because silver is essential for advanced semiconductor manufacturing. It's needed for solar panel production at scale. Military defense systems depend on it. Aerospace applications require it. Modern medicine uses it. The electrical grid needs it. Without sufficient silver supply, entire industries grind to a halt. Here's the supply-demand problem. Mining production of silver isn't keeping pace with exploding demand from all these competing sectors. You have too many buyers chasing not enough physical metal. Basic economics says prices should rise, and that's exactly what's happening. But here's where the story gets really interesting and connects back to everything I said about China. The single biggest shock to the silver market right now is coming from China. And what's happening there reveals the psychology of an entire nation waking up to resource scarcity. Chinese investors, both institutional and retail, have figured out something that Western markets really don't like to openly discuss. In the paper Silver Markets, meaning futures, contracts, and exchange-traded funds, there could be more than 100 contracts claiming ownership of silver for every single physical ounce that actually exists in vaults and can be delivered. It's essentially fractional reserve banking applied to precious metals trading. Once you understand that reality, the rational response becomes crystal clear. If you want actual silver exposure, you need to buy physical metal and take delivery. You cannot trust paper promises when the ratio is potentially 100 to 1. That's exactly what's happening in China right now on a scale that's creating genuine market disruption. Everyone, and I mean everyone, wants physical metal, not paper contracts, not synthetic exposure, actual bars and coins they can hold. The demand has exploded to the point where we now have legitimate shortages developing in the domestic Chinese physical silver market. Let me give you specific numbers that show how insane this has gotten. Silver investment funds operating in China are getting massively oversubscribed beyond any historical precedent. The UBS Silver Fund in China has become so saturated with investor money that people are literally paying 60% premiums over the net asset value of the actual silver held inside the fund. Read that again slowly. Investors are willingly paying 60% more than the metal is actually worth just to get exposure to silver through this vehicle. They're paying $160 for every dollar of silver value. Please note that everything I'm sharing here is strictly for educational and informational purposes only. This is not financial advice, and I'm not a licensed financial advisor. You should always conduct your own thorough research and consult with qualified professionals before making any investment or financial decisions. Financial markets are inherently unpredictable, and past performance never guarantees future results. Now, obviously that 60% premium is extremely dangerous from a pure investment standpoint. If that premium collapses back to zero, which it eventually will, investors are facing catastrophic losses. Even if the underlying silver price stays completely flat, that's reckless speculation by any measure. But here's what that behavior reveals about the psychology and the reality on the ground. And it tells us two absolutely critical facts. First, physical silver supply in China is so extraordinarily tight that people cannot acquire metal through normal channels at any reasonable price. The shortage is real and severe. Second, investors are genuinely, desperately afraid that they won't be able to acquire any silver at all in the future, regardless of price. So they're front-running, paying literally whatever it takes today, and hoping that prices will continue rising fast enough to eventually justify even these absurd premiums. That's fear-driven buying, and it's a powerful force. The premium between Chinese domestic silver prices and international prices reveals just how extreme the situation has become. Silver is now trading above $80 per ounce in local Chinese markets. That's roughly 10% higher than the global spot price. In normal efficient markets, this kind of arbitrage gap would be instantly exploited by traders, moving metal from low-price regions to high-price regions until prices equalized. The fact that a 10% gap persists and even widens tells you that physical supply is so constrained that normal arbitrage mechanisms have broken down. Now, I need to be completely honest and balanced with you here. What's happening in Chinese silver markets right now has absolutely turned into a speculative mania. Mania, by definition, cannot last forever. There's a very real and significant probability of a sharp price correction coming at some point. Some corrective selling is already happening as I record this. What we're witnessing is not calm, rational, efficient market behavior. This is speculative excess driven by fear and greed in equal measure. But, and this is crucial, beneath all the speculation and mania, there is a genuine fundamental story that's not going away. Chinese industries and Chinese investors are absorbing massive quantities of physical silver because they legitimately see its strategic importance for the future. They understand that silver isn't just about making money on price appreciation. It's about securing access to a material that's essential for technology, manufacturing, and national strategic interests. And here's the critical insight that ties everything together. Silver is just one example, one visible case study of a much larger phenomenon. This exact same dynamic is playing out simultaneously across multiple industrial metals and critical materials. China isn't just stockpiling silver in isolation. They're systematically securing the entire periodic table of elements needed for modern industrial civilization. Think about the scope. They're stockpiling copper for electrical infrastructure, lithium for battery production, cobalt for battery stability, nickel for metallurgy, rare earths for magnets and electronics, manganeses for steel production, chromium for stainless steel, tungsten for industrial tooling, molybdenum for high-strength alloys, vanadium for energy storage, gallium for semiconductors, duranium for fiber optics, indium for touchscreens. The list goes on and on. It wouldn't surprise me in the slightest if state-owned enterprises are quietly accumulating billions of dollars worth of these materials, billions of ounces across various metals in quantities that never show up in official government statistics or public reports. And this is strategic resource competition happening in real time at a scale that's unprecedented in peacetime. And most people have no idea it's occurring because it's not dramatic. There are no explosions. There's no breaking news. Just patient systematic buying month after month, year after year. If this analysis is resonating with you and you're understanding the bigger picture, do me a solid right now. Smash that like button so the algorithm shows this video to more people who need to understand what's happening, and drop a comment below telling me what you think. Do you believe China's resource strategy will ultimately succeed in reshaping global power dynamics? How concerned should Western nations be? Let me know your thoughts, because I read every single comment and your insights genuinely help shape future videos. Beijing understands something profound that Western nations are only slowly beginning to grasp. Whoever controls critical materials doesn't just participate in the future economy. They control it. They determine who gets to manufacture what. They determine which countries can build advanced industries and which ones become permanently dependent. This is the kind of leverage that doesn't require military force or political coercion. It's power that comes from owning the physical foundations of industrial activity. And they're moving with decisive speed and unlimited funding. While Western nations are still forming committees and writing reports to study the problem, by the time those reports are finished and recommendations are made and budgets are approved and programs are launched, China will have already secured dominant positions across dozens of critical supply chains. The window for competition is narrowing rapidly. And remember what I said earlier, every ton of copper, every kilogram of lithium, Every ounce of silver that China buys requires converting dollar reserves into physical assets. That's constant, relentless downward pressure on dollar demand. It's more erosion of dollar dominance happening through 1,000 individual transactions that add up to a fundamental shift. Now, there's another major factor that's going to significantly accelerate dollar weakness as we move through 2026, and it's coming from a direction that most people aren't paying attention to: Japan. And the Japan story is critically important because it involves some of the largest capital flows in the global financial system. The Bank of Japan just raised interest rates recently, and they've clearly signaled that more rate hikes are coming throughout the year. Most casual observers don't understand why this matters, or why it's connected to everything else we've been discussing. So let me explain the mechanism. Japan has been trapped with a collapsing yen currency despite the rate hike. Even after raising rates, the yen hasn't recovered its value against the dollar or other major currencies. This is a massive problem for Japan's economy because it makes all imports more expensive, which directly feeds into domestic inflation. The central bank is now being forced into increasingly aggressive action because they have no choice. Saving the yen from further collapse has become the absolute top priority for Japanese monetary policy, and they've made that explicitly clear. But here's the problem they're facing. Japan has gross government debt approaching 250% of GDP, which is among the highest in the developed world. That's an enormous debt burden. To keep hiking interest rates aggressively without causing their debt service costs to explode and destroy government finances, they're going to need to generate cash from somewhere. And the only realistic source of that cash is selling foreign assets, specifically massive quantities of U.S. Treasury bonds. Japan is currently one of the single largest foreign holders of U.S. government debt. We're talking about more than $1 trillion in Treasury securities. If they begin unwinding even a portion of that position to fund their monetary policy and defend their currency, it puts enormous pressure on U.S. bond markets and, by extension, the dollar. But that's only part of the Japan story. There's another mechanism at play that's equally important: the unwinding of the yen carry trade. For those unfamiliar, the yen carry trade has been one of the absolute largest and most profitable trades in global finance for more than a decade. Here's how it works. Investors and institutions borrow yen at extremely low interest rates. They convert those borrowed yen into dollars. Then they use those dollars to buy higher-yielding U.S. assets like treasury bonds, corporate bonds, or stocks. They pocket the interest rate differential as profit. When executed with leverage, the returns can be substantial. This trade has funneled enormous amounts of money into U.S. markets for years, helping support asset prices and keeping yields lower than they otherwise would be. But the trade only works when Japanese rates stay very low and the yen stays weak or stable. As Japanese rates rise, the fundamentals of this trade deteriorate rapidly. The interest rate gap narrows, reducing profit potential. More importantly, the risk profile changes dramatically. You would have to be completely reckless to keep borrowing yen at higher rates to buy U.S. assets when the yen could suddenly strengthen and destroy you financially. Here's why. If the yen appreciates significantly in value, you now have to repay your yen-denominated loans using a much stronger currency. The amount you owe in dollar terms just increased substantially. Meanwhile, the U.S. assets you bought with that borrowed money might be declining in value as U.S. markets correct. You're losing money on both sides of the trade simultaneously. It's a double impact that can wipe out years of profits instantly. Every sophisticated fund manager and institutional investor involved in this trade understands the risk has become extreme. The math no longer works. The prudent move is to exit. And that's exactly what we're seeing begin. We can absolutely expect this carry trade to continue unwinding throughout 2026 as Japanese rates climb higher and the risk-reward becomes increasingly unfavorable. This isn't speculation. This is financial logic playing out. When that carry trade unwinds, it means money flowing out of U.S. assets. It means selling pressure on U.S. bonds. It means reduced demand for dollars. And it's happening at the exact same time as all the other dollar negative factors we've discussed. These aren't isolated, unrelated events. They're reinforcing dynamics that compound each other. So now I want you to step back and see the complete picture. Connect all these threads together. China is systematically and aggressively converting massive dollar reserves into industrial metals, rare earths, and critical materials while building alternative trade systems denominated in renminbi. The dollar is already in a structural down cycle that historically lasts 5 years or more. Japan is preparing to potentially sell hundreds of billions in treasuries. And we're watching the unwind of carry trades that have supported U.S. asset prices for over a decade. Global trade patterns are shifting away from dollar-denominated transactions. Strategic resources are becoming more valuable relative to fiat currencies. These are not isolated events that you can analyze separately. They're interconnected parts of a fundamental shift in how the global financial system operates and where economic power resides. The effects don't just add together linearly. They multiply. They create feedback loops. Each factor makes the others more significant. The United States will very likely need to debase the dollar even further through money creation to fund its own belated strategic stockpiling of critical materials. That's more supply of dollars entering the system. Both superpowers, the US and China, are now competing for the same finite physical resources. And both of their strategies put sustained downward pressure on dollar value. We're watching a fundamental shift in how wealth is stored and how economic power is projected. Paper currencies are steadily losing relative value, while physical resources and strategic materials are gaining importance. The year 2026 is setting up to be extraordinarily volatile for dollar holders and for anyone with significant wealth denominated in dollar-based assets. The reserve currency is facing multiple severe structural headwinds, all hitting simultaneously. This isn't like previous dollar down cycles, where there was one primary cause. This time, there are 4 or 5 major factors all working in the same direction at once. Most mainstream financial analysts are dramatically underestimating how these factors multiply when they converge, rather than simply adding together. Wall Street tends to analyze each issue in isolation. Trade policy in one box, monetary policy in another box, geopolitical competition in a third box. But that's not how complex systems actually work. Everything affects everything else. The interactions and feedback loops are where the real action happens. This isn't just another market cycle that will reverse when the Fed changes policy or when some trade deal gets signed. This is a generational shift in the structure of the global financial system. The framework that has dominated since the end of World War II is being challenged not by military invasion, but by patient strategic economic positioning. China has been playing the long game for decades, systematically accumulating the physical foundations of industrial power. While Western nations focused on financial engineering and asset price inflation, Japan is being forced by circumstances beyond their control to prioritize yen stability over continuing to support U.S. markets with their capital. And the dollar is caught in the middle of economic forces it cannot easily control through traditional monetary policy tools. You can't just raise interest rates and make these structural problems go away. Here's what this means for you personally. If you're holding significant wealth in dollars or dollar-denominated assets, the assumptions and strategies that worked perfectly well for the past 50 years might not work at all for the next 50. It means understanding that real physical assets, tangible resources, and strategic materials are likely becoming more valuable over time relative to paper currencies. It means recognizing that we're entering an extended period of monetary instability where traditional safe havens might not perform as historically expected. It means thinking carefully about diversification, not just across different stocks or bonds, but across different asset classes entirely, and potentially across different currencies. It means understanding that the rules are changing, and the change is being driven by forces much larger than any single central bank or government can control. So let me know in the comments what you think about all this. Will China's industrial metals stockpiling strategy ultimately succeed in fundamentally reshaping global economic power dynamics? Can the US dollar maintain its reserve currency status through this massive transition? Or are we watching the beginning of a shift to a multipolar currency system? How are you personally thinking about positioning your finances and your wealth for what could be a very turbulent 5 to 10 years ahead? I genuinely want to hear your perspective on this because these are literally the most important economic and financial questions of our time. The decisions being made right now by governments and central banks and by individual investors are going to echo for decades. Stay safe out there, stay informed, and remember that knowledge and understanding are your absolute best defense during periods of major uncertainty and transition. If you found this deep analysis valuable, and you think others need to understand what's really happening beneath the surface of headlines, do me a favor and share this video with them. Send it to friends, family, colleagues, anyone who cares about protecting their financial future. And make sure you're subscribed to this channel because I am constantly tracking these deep structural trends and bringing you insights and analysis that mainstream financial media either completely misses or deliberately won't tell you because it doesn't fit their narrative. I am not beholden to advertisers or corporate sponsors. I can tell you the truth as I see it based on evidence and research. Thanks for watching, thanks for engaging, and I'll see you in the next video where we'll continue following this story as it develops and unfolds in real time. Because trust me, this story is far from over. We're just getting started.